Hey guys, it's Adam Rose, Vice President and Senior Loan Officer of Western Ohio Mortgage here in Sydney, Ohio. This is another episode of the Mortgage Guy podcast, and this is a little one where you get to know a little bit about self-employed borrowers. You know, we get a lot of those around here. It's rural America. Hell, I think half the population might own their own business, even if they have a day job, right? There seems to be a common theme of people having side gigs and in filing those taxes on their Schedule Cs and self-employment. So I wanted to touch on that a little bit here. So some of the pitfalls, right? Some of the mistakes some people make, what we have to look at. So let's go with the self-employed. Let's just say you're just fully self-employed, okay? And that's your primary income. Well, in order to qualify for a mortgage, we need to usually have 2 years of tax filings, all right? 2 full years of tax filings. Can we get away with 18 months or self-employment? Yes, we can. Okay. Like to see the 2 years of tax filings, though. So we obviously know that if you have 18 months, but you snuck in there at a certain period of time when you started your business and you have 2 tax filings, the income might be a little off. But what we're doing is we're reviewing that income and is not your gross. A lot of people think, well, I made $100,000. And we look at the taxes, and that was the gross, and then after write-offs, it was 35 or whatever it might be. So we're going to be looking at that bottom line. Okay, so if you're a self-employed individual, make sure you're taking a look at your tax returns to give yourself a little bit of an idea of how much you might be able to use for qualifying income. So again, we're going to be using that net income on your Schedule C. It might be 1120S, which is the S corp or partnerships. All right, tax filings. But let's just say you're nice and easy, self-employed, sole proprietor. We're going to be looking at Schedule C. And we're going to be looking at that bottom line. Now, there's a little bit of income that we can write back in, okay? Because you're going to take those deductions. That's the great thing. That's the beauty about being self-employed, right? You might get some tax benefits finally. No one else does, right? Seems like. So you're going to take those write-offs. You're going to pay minimal taxes, which is fantastic. It helps your bottom line. However, when applying for that mortgage, we are going to be looking at those physical write-offs, and there's a little bit that we can write back in, okay? So depreciation expense is the most common write-off that we have. People that have equipment, vehicles, they own property, right? You can depreciate it out. Depreciation is truly a paper write-off. It is not a physical expense that you have when running your business. So if your bottom line says $30,000, but you got $10,000 of depreciation expense, we can put that right back into your income. Now we're at $40,000 for qualifying income. Okay, so just a little note there. One of the things that we are also going to need as a self-employed borrower is, depending on what time of year, where we're at when you're applying for the mortgage loan. If you're at the very February, March, we're probably going to be fine without it. But if you get into those May, June, July, and later, we're going to have to get a year-to-date profit and loss statement, okay? So we're going to grab your 2 years of tax returns. We're going to calculate your income. And what we're doing is we're kind of averaging it out over the last 2 years, kind of see, all right, and this year they made X, this year they made X, it went up a little bit. We're going to average it out. We're also going to show year-to-date income where you are, right? So if you've been averaging $40,000 a year of income, but it's July, we're in the middle of the year, and year-to-date you've only made 10, that's going to be a problem, right? We want to show that you've already profited $20,000 to show you that you are on pace to still continue to hit that $40,000. So you can pull that from QuickBooks. You can put it on paper. It's very simple. You're going to put your gross receipts. You're going to take your basic deductions, right? Like, hey, here's my mileage. Here's my overhead expense that I've had. It doesn't have to be a full statement that you would get from an accountant. It can be pretty basic. We just need to see that you're on pace, right, for the last 2 years average. So that's just a heads up for your self-employed borrowers. 2 years of taxes, profit and loss statement for year-to-date income. Just make sure we're on pace, okay? Next thing we're going to look at, we are going to look at taxes owed. Remember, you're self-employed. No one is deducting the taxes for you off your paycheck, right? So that is your responsibility, and a lot of times this catches people up a little bit. I do highly encourage people to pay taxes quarterly based off of what they expect their tax liability to be. That is fantastic. Makes it nice and easy, and you don't have this big old balance at the end of the year or in the new year when you file your taxes. So do that if you can. We're going to look at that bottom line and say, hey, you've owed $15,000 to the IRS. Is that paid yet? This catches people up more than probably anything when it comes to self-employment. So let's go through this a little bit. So you don't make your quarterly payments to the IRS. No one wants to, right? I get it. You probably wait until the end of the year and be like, all right, let's see what we can write off here to reduce my tax liability. But let's say you filed your taxes. It's April. You didn't do an extension, and you owe $10,000 to the IRS. Well, when we get those tax returns and we see that, we have to document, hey, have these been paid in full, right? You can't just say yes. We have to document it, guys. So we're going to go to the IRS to validate it. If you have not, it is acceptable to set up a payment arrangement with the IRS. And it's really not that hard. It sounds complicated. You think you're going to be on the phone for hours. You're not, okay? If you owe less than $50,000 to the IRS, you can go online to irs.gov. Okay, we'll put some links onto the YouTube channel here for you to check it out. And you can just set up an account anyways. It's not a bad idea. So you can go out there, set up the account. They'll validate who you are, obviously. They'll pull up your tax liability. You want to double check some things just to make sure it's you and there's no mistake. But you can do an ACH automatic withdrawal and set up a payment arrangement right there. A lot of times they will let you pick the payment amount if the amount is not too outrageous. Okay, we've seen people do $50 a month on $20,000. So they will let you pick. But I think I don't know the rules. We'll have to double check. I think it has to be paid over a 5-year period of time, though, if I'm not mistaken. We'll have to look into that. But you can set up that payment arrangement. That is acceptable. We can help you log into irs.gov. We'll pull that information, show what the payment arrangement is. Boom, we're done. We're going to include that in your debt ratios. We move on with our day. Number 2, on the IRS, if you owe more than $50,000, which let me tell you, it happens. Okay, it can creep up on people, and remember, it's going to continue to accumulate too. So if you didn't pay your 21s and all in full and 22s, there's a new balance. It's going to keep accumulating. So it's very easy to exceed that $50,000 amount. It gets a little bit more challenging. Okay, you do have to call. This is the thing that everybody dreads, and it does take some time. But you have to call in to set up that payment arrangement. They'll have to agree to it. Then they send you paperwork. All right, that's going to take weeks. I mean weeks. If we're trying to do this in the middle of the loan process, it is quite the challenge. We're going to get extensions, and hopefully your seller will extend. But that's why I'm sending this video out here. Okay, prepare you for this, because a lot of people that are self-employed, they file extensions on their taxes, and October 15 is your deadline. So that's coming up in a month. So be prepared for this. If you owe more than $50,000, start setting up those payment arrangements immediately. All right. And another option, actually, there's a third option. When you do file your taxes, there is actually a form in there. So if you use a CPA, there's a form in there that you can fill out that says, "Hey, I know I owe $12,000 to the IRS. I would like to pay $100 a month." And if you submit that with your tax returns, that is acceptable as well. I mean, we still have to document you owe less than 50, but that is acceptable. So just a heads up, guys, pay attention to this. Okay. On that, okay. So we are allowed to accept those payment arrangements in those payment structures with the IRS. That is allowed, and we can move on with our day. But when there are judgments or liens, taxes owed, not just taxes that are delinquent in nature, right? You can set up a payment arrangement with that. But tax liens, that is a whole different ballgame, okay? Tax liens have to be either paid in full, or you have a payment arrangement set up and you've made 3 monthly payments. Not 3 monthly payments all at once, okay? Month 1, paid. Month 2, paid. Month 3, paid, right? January 1, February 1, March 1, whatever. And we have to document that payment history. Once you made 3 regular monthly payments, now we can count it in your debt to income ratios and move on with our day, okay? So just a couple of different little nuances with taxes owed and self-employed borrowers, and some of the common things that we run into, okay? When we run into this stuff also, let's say we get our income calculation completed, okay? And it's just not quite where we want it to be in order to qualify for the loan amount that you want, okay? For a traditional mortgage, conventional FHA, VA, USD, whatever it might be. There's another option, okay? It's pretty slick. I've done a couple already. There's a lot of lenders that might be able to do these, that broker them out. They typically don't do them in-house. But it's called a bank statement loan. Okay, so I had a borrower. It was just this year. It was about 4 or 5 months ago. And after all the write-offs and all that fun stuff, I think we were showing like $3,000 a month of income, and it just wasn't enough. We couldn't qualify. So we had to go the bank statement route. So basically, we're going to collect 12 months of bank statements, analyze the deposits, okay, every month over that 12-month period of time, and then use 50% of those deposits as qualifying income. So we took a guy from $3,000 a month of income to $21,000 a month of income. He more than qualified for the house that he was trying to buy. So it's a very neat program. It takes a little bit longer to do. All right. I closed that one in 2 weeks, which is not normal at all. My foot was on the pedal. Okay. Due to certain circumstances. So you have to prepare for that. It's usually a 30 to 40 day process to get those bank statement loans closed, but it is an option. Now, the downside of doing the bank statement loans, if you're not prepared with qualifying for a certain amount, the rate is a little different. All right, it's a non-qualified mortgage. It's non-traditional financing. Okay, it's not your traditional, conventional USDA 30-year fixed. It is you have a fixed rate option, right? They have adjustable rate mortgage options. They have a lot of different things going on, but the rate is going to be higher than the market. And I know that's a tough pill to swallow, especially with what's going on in the market today. But if you found that home that you just absolutely fell in love with and you got to buy it, that is your backup plan. All right, we can put that in your back pocket and get you into that home of your dreams. All right, so just a couple of tips, guys, for self-employed borrowers. I hope you get to check this out and you listen to what I'm telling you and you prepare yourself. Okay, prepare yourself. That is key for self-employed borrowers. So check us out again next week, guys. Again, that's going to be it for us this week. We're going to have a lot more neat little mortgage tips for you coming up. But check us out on YouTube and make sure you subscribe. Check us out on Spotify and Apple Podcasts, and we'll see you guys next week.